Purchase price, PMI, APR. Which of the three matters the most when considering which loan option is best for you? And how can you minimize the amount of total interest that you pay over time? Well, in this video, we're gonna work through some examples comparing the purchase price, PMI, and APR so that you can see exactly how that affects the total interest you pay over the lifetime of the loan. So as you can see, we're gonna compare a loan of $400,000 versus $420,000. Now, at face value, it may seem better that you're buying a property at $400,000 rather than $420,000, but the $400,000 loan is at a 6.2% interest rate, whereas the $420,000 loan is at a 5.9 interest rate. So, which loan do you think will result in the least amount of interest paid over time? Well, if you calculate it out, loan one, which is the $400,000 loan, will have a monthly payment of $2,450 and a total interest over time at $482,000. Loan two, although it's a higher monthly payment, will actually result in less interest paid over time at $476,822. So as you can see, it's just a slight variation of the interest rate, but it makes a massive difference over the lifetime of the loan. A $490,000 loan at a 4.5% interest rate over a 30-year period will lead to even more less interest paid. Now, it may have a middle grade monthly payment of $2,482, but the total interest over the lifetime of the loan is $403,000. So as you can see with this one example, interest rate is one of the most important factors to consider when you're looking at different loans. For our second example here, we're gonna look at the effect that PMI over your loan. So for this example, we're gonna use a home value of $500,000. For our example, we're only gonna have a down payment of 10%, which is $50,000. So the loan amount is $450,000. At an interest rate of 5.9%, property tax at $5,500 per year. And for this example, we're gonna include a PMI at 0.5% per year. Now, for most lenders, PMI is anywhere from 0.5 to 1.0%. Home insurance at $1,000, no HOA, and we're gonna calculate exactly what our monthly payment is. So for this example, we're looking at about a $3,400 payment per month, including PMI. Now this includes the property taxes and the home insurance with this as well. Over the lifetime of the loan, it's gonna be a $1.17 million total, okay? So keep that in mind, the $1.17 million. Now we're gonna take PMI out of the equation altogether. And if we do that, it drops to $3,200 per month as a payment. So as you can see, you're already significantly reducing your monthly cost for that mortgage. Now we're gonna get rid of PMI altogether. So as you can see, just by getting rid of PMI, we're reducing that monthly payment to $3,200. And over the lifetime of the loan, it's $1.15 million. So over $20,000 of interest just over the lifetime of the loan by having that PMI. So as you can tell with this example, it behooves you to avoid PMI if at all possible. Going back to that example with the PMI itself, as you can see, if you're only putting 10% down on the loan for this example, it'll take you a total of 87 PMI payments in order to get rid of PMI altogether. Now, private mortgage insurance is an insurance that exists on your loan while you're under that 20% threshold. So as soon as you have enough equity in your house and that loan to meet that 20% mark, it'll get rid of the PMI altogether. So for this example, if you can come up with an extra $50,000, you will save $16,000 just within the PMI payments alone. So it may be worthwhile depending on your financial situation. So do the math. Use the calculators, which are linked down below, to better determine how you can minimize the amount of interest you pay over the lifetime of the loan. And don't focus so much on the purchase price, because at the end of the day, as we saw with these examples, it matters far more if you're paying PMI and what your APR on that loan is itself. Key takeaway here is that interest rates matter far more than the purchase price of the loan itself. Don't fixate on how much money you're paying for the property. Focus on how you can minimize the total cost of that loan over the lifetime of that loan. Try to get rid of PMI if at all possible. The best case scenario is minimizing that APR and having no PMI on the loan itself. If you found this video helpful, like and subscribe. Comment below to give me feedback to better tailor these videos to meet your needs. Thanks, and I'll see you around.